Hey everyone, it's Chad with Spyrnal Financial Group. Wanted to have a little update on the presidential elections. A lot of us are thinking about if Trump wins, if Biden wins, and how this affects our portfolios. We have a unique opportunity to have Michael Sorrentino on here. He is one of our chief investment officers that helps provide a lot of insight in the market, as well as one of the head investors to many of the portfolios that we run here. So I'm going to take it over, let him go ahead and speak on a lot of this pieces here. I'll interject with some questions that you guys have been asking me over these last couple weeks, and let's see where we can go here. So Mike, thanks for joining us. Go ahead, and like I said, I'll be here to interject every once in a while.
Well, my pleasure, Chad. It's great to be here. And hi, everybody. I'm going to go ahead and turn my video off so that way we can focus on the slides and the information. Look, this is clearly a subject that is on the minds of most investors today. And I will say that I only have one request going forward. One request from everybody that's listening to this webinar today is I want at this very moment, take a deep breath. And then when you exhale, I want you to push out all of your political beliefs, as many as you can, all of the emotions, all the anger, the excitement, whatever you think about when we start talking about politics and presidential elections. Let's try our hardest as a collective group to push that aside just for a few minutes. And the reason for that is that it will make this conversation far more productive, no matter what side of the fence you sit on. So with that, let's get into the material. There is a lot to talk about here today. What I want to do first and foremost is level set the conversation. Where are we today? All right, we're less than 2 weeks away from the election. And if you look at the polling numbers, the headline numbers rather, it looks almost kind of like a slam dunk for Biden. Biden's winning right now up by, call it 9 points or so, which is it's a pretty big lead. If you think about these polls, I mean, realistically, I think we've all learned that they don't necessarily mean all that much in the grand scheme of things. They're not always accurate. All right. So what I want to do is I went and I compared the current poll data today to where it was this time in the cycle, the election cycle during the Trump-Clinton days back in 2016. So again, less than 2 weeks away from that election in 2016. How does it look today versus back then? So today, Trump is currently trailing Biden by 9 points. Back then, Trump was trailing Clinton by 6 points. Okay, so yes, still trailing by more, but not much more. And furthermore, and this is where it gets interesting, if you look at the states that matter, in my opinion, there's only 6 states that matter in this election, maybe 7. Pennsylvania, Milwaukee, Wisconsin, Michigan. Wow. Michigan, Wisconsin, yeah, one of those. Florida, North Carolina, and Arizona. Okay, if you look at those states, and you look at the polling numbers there from Real Clear Politics, that's where I'm getting my data from, okay, Trump is polling better. Better than where he was relative to Hillary Clinton. Okay, so I'm not saying Trump's ahead in these polls. He's just in a better spot than where he was relative to Clinton. Okay, this election is not over. It's absolutely not over. So this is going to be hopefully some pretty timely information in regards to what we think could potentially happen after the election in a couple days. So what we're going to do going forward is we're going to spend some time talking about historical performance. What has happened in the past to the S&P 500 during other elections? Okay, is it better to see a Republican, a Democrat in office, as a result of the election, all of that fun stuff. From there, we want to get a sense of what could potentially happen going forward after this election. There's a lot of outcomes, okay? Again, it's not just the White House up for grabs right now. Congress is, there could be a shift in Congress as well, too. We got to talk about that and the implications. And then from there, the third thing, talk about what it is that we here plan to do as investors. As fundamental long-term investors, how does the election impact our plan going forward? One of my favorite quotes of all time from Benjamin Disraeli. There are 3 types of lies: lies, damned lies, and statistics. Be very, very careful about any data whatsoever that you hear about online or on the news or on TV anywhere when it comes to the election and the stock market. Okay, it is very easy to manipulate this stuff. I'll show you how. So I went back over 100 years, or almost 100 years. I pulled the total return of the S&P 500 every year for going back to 1926. Okay, so total return being the price appreciation plus the dividends each year. So that purple bar on the chart represents each year of returns for the S&P 500. Then what I did is I went back in all 22 years where we had an election over that time period, I made the bar red, just so they kind of stand out a little bit, all right? Now, we had 4 years where we had an election and the market was down, or the S&P 500 was down. 1932, 1940, 2000, and 2008. 3 of those 4 years just happened to also be 3 of the worst economic environments that our country has ever had. Okay, so you can't tell me with a straight face that the S&P 500 lost money in those 4 years because of the election. Okay, and furthermore, you absolutely can't tell me that the election caused the financial crisis in 2008. You can't tell me it caused a dot-com bubble to burst. And you certainly can't tell me it caused the Great Depression. Okay, so my point here is that do elections matter? Yeah, over the long run, it doesn't matter who's sitting in the White House and who's in Congress. But the election itself most certainly cannot explain the near-term performance in stocks. So let's take a step further, okay? Who's better for the market? So what I did was I took that data we saw on the previous slide, and I compiled it. And I said, okay, what was the average return of those election years when a Republican won? And what was the average return of the years where a Democrat won? And as you can see, Republicans, we saw a 15.3% return over those years, and the Democrats were about half that. So immediately, I'm sure we've got a lot of Republicans doing high fives on the webinar today saying, hey, we're better, okay? But again, you gotta think about the time frame and how applicable this data really is. Because look, I mean, the election year, the election's in November, it's not in January, right? So if you think about it from that perspective, what does the S&P 500 return during an election year really tell us? Not all that much. So I'm going to take this even a step even further. What I'm going to do now is look at the year after. Okay, so the election year, okay, it's in November, big deal. What I really want to know is once that president gets in office, okay, once he or she gets in the White House, unpacks the suitcase, starts firing all the old people and hiring a bunch of new people for the new cabinet, what happens that year in the market? Okay, so I'm talking 2017, 2013, 2009, and so on. So I went back over 40 years on this data, and as you can see, when a Republican won the presidency, the first year while that Republican was in office, the average return of the S&P 500 was 12.3%. Now, the long-term average of all years over the last 50 years or so has been 9.8, 9.9%. Okay, so that means that when a Republican gets in office, their first year in office, generally speaking, they outperform the S&P 500 by about 25%. That's a pretty cool return. I mean, that's a great return, actually. Look at the Democrats, though. The Democrats are up 19%, double. It's pretty much double the long-term average. All right? So Democrats can look at the data and say, all right, you might think you're hot stuff, Republicans, but guess what? When it really matters, that whole year, when we're in the office for the first time, look what happened in the market, all right? My argument is there is no conclusion here. This is just an example of how all you have to do is to take the exact same data set and show it through a different lens to derive a conclusion, which is what happens on TV all the time, right? You put some Democratic strategist on TV and they show some chart about something very similar to this. They say, well, clearly the Democrats are better for the economy. Or you've got a Republican who does something like this. Well, clearly the Republicans are better for the economy. All right? Just be very careful about that data out there, because I'm telling you, I've looked at this data upside down, left and right, through every lens you could imagine for years. And I have yet to find any type of pattern whatsoever to say one is better than the other for the market. And you'll see why from a fundamental perspective. I'll even take
that looks crazy. Yeah, we're looking at the exact same data there. I mean, it's all the exact same numbers back to 1924.
It's the exact same numbers. You're right. And the only thing I did was I changed the time frame. Okay, so it was just a matter of just moving it a little bit to the left, a little bit to the right, and you can back up any conclusion that you want to make. So my argument here is that you're right. There's no real pattern per se, but if you take a step back and say if you don't ask the question of who's better and ask the question of do they really matter all that much, you get a little bit more clarity, which is I think what we're seeing out here. So think about the number 130, okay? Because during President Obama's administration, the S&P 500 hit an all-time high just under 130 times. And that's a big number. 130 all-time highs in 8 years is a big number. Now, President Trump got just over 130 in 4 years, or less than 4 years. Okay, so again, I know what's happening. And the Trump supporters are like, oh, hey, yeah, Trump's better, right? He didn't have the time. He more than half the time, which is true. But my argument is that they're both pretty awesome. Okay, it's not like there were no all-time highs under the Democrat and a bunch on the Republican. I mean, there were just fewer. But think about it. If you held stocks over the last 12 years, irrespective of if we had a Republican or Democrat in the office, you're up big time. And we're talking about multiples of your initial investment. So to me, could you have done better if Obama was not in office and somebody else, a Republican? Maybe. I don't know. Maybe, probably. But I'll take a triple. I mean, when he was in office, the market tripled. Okay, so and keep in mind, President Obama was one of the most unfriendly presidents in modern history towards businesses, and the regulatory environment he put down in this country was something we haven't seen in decades. But it still wasn't enough to cause the U.S. economy to fall apart. That's a very key important point to remember, because I know that there are people out there worried about a Biden win, and I'm telling you, the president just doesn't have that kind of power. Now, he or she can destroy parts of the economy or promote parts of the economy, but that's a different story we'll get into later. And it's also very important to remember that stocks can go down too, Chad. Look, you've got every single president going down to the exact same data set that I've been showing. Every single president has had some type of major drawdown during their tenure. I mean, George Bush, a Republican, saw the market go down 52% in his presidency. I mean, that is not a legacy you really want to brag about. That's tough, right? But every president's seen something like that. So, whoa, way too fast. So my point here is that if you were to invest $1 back in 1926, like I've been showing, $1 in the S&P 500, even though it's not an investable index, you get the idea. So you invest $1 in that index. Today, you've got over $10,000, right? That's a pretty awesome return over 100 years. But more importantly is that if I look at this chart, I see a lot of Democratic presidents, and a lot of Republican presidents. There's a lot of blue and red mixed together there, all right? And the other thing that I see here is a very, very consistent trend of up and to the right. If you can focus on the fundamentals of what's driving our economy and ignore the politics, you can do really well if you invest in the U.S. So we got to talk about Congress too. Like I said earlier, this is not just a race for the White House. I call Congress the promise filter, okay? You know, if I'm Trump or Biden, I'm running around the country right now promising one thing in Naples, Florida one day, and San Francisco something completely different the next, maybe New York the next day. I could just, whatever comes to mind, I'm just going to say it, all right? I'm going to promise you this, that, and the other. Well, Congress says, no, not on my watch, all right? I'm a congressman. I'm just like you. I'm self-interested. I'm not losing my job because you just said something stupid on the campaign trail. They're a filter. They take these promises and remove the ones that are insane or just dumb or whatever it may be, and they are the ones that decide what becomes policy in our country. And it is important to consider who is running Congress. But even if you look at the data, it doesn't really give us a good representation of a consistent pattern, okay? Under a Democratic president, for example, if we have a Democratic president, we've done better in the years where we've actually had a Republican-led Congress. I mean, tell me if that makes an ounce of sense. I mean, I mean, you would have think it would be some type of a differential. I mean, or for that matter, a Republican president. When we've had a Republican president, it's done best when there's been a split. That doesn't make any sense either. I mean, when you have a split Congress, sometimes even less gets done. So the point here is not to confuse everybody with all these different data sets. It's to show that there's no pattern. There's literally no pattern. Whoever's in the White House, whoever's in Congress, it's really, really hard to say based on those two variables, or those two factors rather, that you have some type of an idea of what the future is going to look like for the stock market. These are not factors that tend to drive stocks over the long run. So 3 conclusions I want everybody to keep in mind here and be very clear. Stocks have performed well during both Republican and Democratic administrations. Stocks have also lost money during both Democratic and Republican administrations. 3, I'm hammering this home for a reason. There's no evidence whatsoever to suggest that one party is better than the other for the stock market, just simply based on who's in an office. Okay, so that's what history tells us. I wish I had a better punchline for you. I wish I could tell you, look, it's always the Republicans or something like that. It's not. There's no pattern. So what we cannot do is say, if Trump wins or Biden wins, that we have an idea of what the market's going to do. It doesn't work like that. So when you hear this stuff online, when you see this stuff online, you hear it on the TV, just roll your eyes like I do and move on. Speaking of moving on, let's talk about next steps. There's a great, so Charlie Munger is Warren Buffett's right-hand man. He's a very bright guy. He's known for being very blunt when he speaks. He wrote a book that you can actually download online for free. It's called The Psychology of Misjudgment. It's about an hour and a half read. And basically he depicts and breaks down all these different mental models that we as humans use to make bad decisions effectively. So it's an idea like maybe we could do better by recognizing our faults. That sort of approach. He had a great quote in there. Basically, politics is the art of marshaling hatred. And I could safely say, Chad, I think you agree that over the past 18 months, we have had a lot of politics. I mean, a lot of politics and a lot of hatred and very, very little, as you'll see, policy discussion. Yeah. Because there's a difference, all right? There's a huge difference between politics and policy. All right, politics, as I mentioned, is what we've been dealing with for 18 months. It's flimsy, it's weak. The speed of politics is lightning fast. You have absolutely no accountability. You can say whatever you want. It doesn't matter. Nobody's going to hold your feet to the fire. The flexibility is limitless, because what are we trying to do? As a politician, I'm trying to tap into your emotional core for one reason and one reason only. I want your vote. I want you to put my name on the ballot or check my name on the ballot when you go to vote. That's it. That's all I care about. That's a singular objective of politics. When the election is done, politics gets flushed down the drain for the most part. That's the goal, to win votes. It's short term, it's emotional. When you think about policy is vetted. It's incredibly firm. It moves at a glacial pace. There's an insane amount of accountability, okay? If I'm a Democratic senator and I vote to raise taxes, I better know what I'm doing, okay? Because if I don't, and I make a mistake or I do something too radical, I'm going to lose my job, all right? I'm going to lose my job and I'll never get it back. And that's not what I want, okay? So there is a sense of accountability when it comes to policy. It's vetted for a reason, because this is the stuff that matters. This changes economies. This changes everything, the way we live our lives, our freedoms, everything comes down to policy. So as frustrating it is that our government works at such a snail's pace at times, this is the reason why it's done this way. The drivers of policy are fundamental. They're long-term. They're set in stone. This is to enact change. So if you think about it, let's juxtapose this towards the equity market. In the short term in the stock market, fear, panic, greed, euphoria, stupidity, all that moves markets. The emotions of the market drive the short-term movements, the ups and downs. But emotions can't derail $20 trillion economies, nor can they fuel them, really. The fundamentals will really drive the market over the long run. The fundamentals like cash flow, earnings, things of that nature. It's the same thing here. Politics can absolutely impact the stock market for a short amount of time, days, weeks, a month or two, or something like that. But policy, that's what drives the market. That's what drives the economy over the long run. That's what you have to focus on, all right? Because I am not smart enough, or I don't have a crystal ball to figure out what the emotional response is going to be from something like the election. If you tell me what's going to happen if Biden wins or Trump wins, I don't know. I don't have a clue what's going to happen in the market. If I knew that, no offense, I wouldn't be here right now. I'd be shopping for an island somewhere. I'd be that rich, all right? That's not my game. What I'm trying to do is try to get an idea of what the policy is going to look like going forward. Now, I'm not going to ignore the politics. I'm not going to ignore the emotions, because that's the opportunity, I think, in the short term, is that there might be an opportunity for investors that are patient and willing to have a strong stomach. There might be an opportunity if the market sells off to buy stocks that go on sale. We'll get into that later. But my point here is we got to focus on the policy going forward. And I'm telling you, we have very little information so far of what that's going to look like. Here are some of the potential outcomes, though. Again, it's kind of like a, kind of a Punnett square of sorts, where you got the White House on the top and then Congress kind of on the side here. All right. So if in this, we have basically four potential outcomes. Technically speaking, five, and I'll explain that in a second. The first is a Trump win and Republicans take Congress. I think the odds of this are low-ish. It's not impossible, definitely not impossible, but this would be, quote unquote, a surprise. If we see that, we're going to see extended tax cuts, deepening tax cuts, and certainly less regulation. If we have a situation where Trump wins the White House and the Democrats take Congress, that will be more of a status quo. All right, we're going to have what we have right now. Very few compromises. It's what we've been dealing with for a while now. And honestly, I would say that that's not kind of the base case for Wall Street right now. I think the base case for Wall Street is a Biden win, but Republicans keep control of Congress. Republicans have control of Congress, rather. That's kind of, from what I'm seeing, is I'm not Congress. Republicans keep the Senate. Excuse me. Republicans keep the Senate.
I was going to jump in. So you're thinking, and I've read this a few times. I know we've had some conversations about it. That we think that the Wall Street is already, we'll call, pricing in or thinking that Biden is got this. Obviously, from that first couple slides you brought in, he's already 9 points ahead according to polls. So you're thinking that the Wall Street already is going down that route from the big guys, right? The big hedge funds and mutual fund managers.
Correct. I mean, that's if you look at the research that's out there and the poll data and whatnot, it does appear that the base case right now is a Biden win, and the Senate remains under Republican control. Now, the Democrats right now have 47 seats in the Senate. Picking up an extra, call it 4 or 5 seats, is going to be difficult, not impossible. Something like that. And in this base case that we've got here, called the base case for Wall Street, not much is going to get done. The Republicans will never allow any major tax changes to get through Senate. They're going to kill anything that comes their way. In the spirit of compromise, you might see a couple small things eke through, like out in crazy California, or maybe in New York, some of these higher tax states that can no longer write off their state taxes from the federal, they might bump that threshold from 10,000 to 20,000, something like that. They might throw those states a bone, just like I said, in the spirit of compromise, to start working maybe a little bit closer with the Democrats. I think compromise would be a welcome change, I think, for the country, frankly. So that's what I see happening in that quadrant of sorts. Where I think the big concern is here, and let me be very clear here, so I'm not coming from a political angle here, but I think there is concern out here for what could potentially happen if Biden were to win and we saw Democrats take the Senate. Because that's what they're kind of talking about, this idea of a blue wave. If that happens, based on the way the tax law has been enacted through the Senate over the past several years, this is where we could start seeing some real tax code changes. Generally speaking, you need to have 60 votes in the Senate to get anything through, but there's a process called the budget reconciliation process. It's a way to effectively force a simple majority vote. Now, this is how most tax law changes have gone through over the past several years, because you don't need that 60 votes. You really just need a simple majority of 50 votes or 51 votes. So in this instance, if this were to happen, if the Democrats picked up 51, 52 seats, somewhere in that range, then we're talking some tax changes. And I'll explain what I think will happen. I don't think anything too radical will happen in this instance. I really don't. Because again, people have to remember that not all Democrats are radical, okay? There are some very moderate Democrats out there, and there are moderate Democrats that want to keep their jobs. So I don't think anything too radical. There is a fifth outcome here, though. It's kind of this extreme outcome where people are certainly worried about what you may have heard in the news every once in a while, a Democratic tsunami, okay? This is if the Democrats take big time seats in Senate. If they have what we call a filibuster-proof majority, okay, and they can creep up to that 60 vote minimum, I don't know, 54, 55, 56 seats, something like that, then we're talking some more extreme policies to get through. Again, I think the odds of this happening are very low, but it is worth considering and thinking through in the event that it does happen. Okay, but remember, this requires the Democrats to get like 7, 8, maybe 9 seats in the Senate. In the Senate world, that is a big deal. That's not an easy thing to do. So my point here is that, look, yes, taxes could go up, but it is not a done deal. If Biden wins, it is not a done deal. Okay, he's got to get. The Democrats have to get in Congress, have to win the Senate. Okay, that in of itself is not going to be easy. But let's say they do that. Okay, then yes, some tax policy will most likely get through, or some tax changes will happen. But the crazy extreme stuff that they're talking about, that the Biden tax inside of the Biden tax plan, that's going to require a filibuster majority. Now we're talking very, very low probability, and I'm making these numbers up. I'm talking like low single-digit probabilities in my mind. I think that's going to be very difficult to pull off, because even if that were to happen, remember, again, Biden wins, he unpacks the stuff in the White House, puts the suitcases away, fires all Trump's people, hires all of his own, creates his cabinet, his administration. You're talking like June, July before any kind of real initiatives for policy get put into place. So let's say it is June, July next year. Guess what? Now you just creeped up towards midterm election political horizon. 18 months away is the midterm elections in 2022. And I'm telling you, I don't think a lot of moderate Democrats are going to be really gung-ho about overtaxing their constituents after one of the worst recessions we've seen in modern history. Okay, what happened this year is going to create ripple effects for a lot of people and a lot of Democrats. And I don't think they want to go back and say, hey, people in California, guess what? I'm the guy that raised your taxes to a 65% effective tax rate. I don't think they're going to do that. Okay, now there is some speculation there built in my estimates, but again, you got to think about the incentives behind these politicians. Yes, they're going to raise taxes, but I don't think anything overly radical will get through. So let's talk about the big five, because the Biden tax plan is, I think, where most of the concern is right now. First thing he wants to do is remove the top income tax bracket from 37 to 39.5%. Again, for incomes over $400,000 or more. So I don't like this idea. I'll be blunt. I hate taxes. I don't like anything about taxes. But that doesn't mean that it's going to cause a recession, okay? We saw 39.5% on the top earners during the Clinton days and as the latter half of Obama's administration. And guess what? No recession. Didn't cause a recession. Now, it annoyed people, yes. Did it slow down the economy? Yeah, it slowed it down. Taxes slow down economies. That's how it works. All right, but it didn't cause a recession. If Biden wins and they get the Senate, Democrats get the Senate, this is going to happen. I think there's a very high probability this will get through. The second one, raising the corporate tax rate from 21 to 28%. I utterly hate this idea, but this
Yeah,
will not cause a recession either.
Yeah, Mike, this is something that you and I were talking about before, and I'm glad this was this showed up on your slides as well. Seeing that, I know that even with that reduction, we saw some infrastructure come back to the U.S. Do we think that increasing that corporate tax rate might push these companies back overseas, or they're just going to start reporting less? Right? There's good accountants for these big corporate firms.
Yeah, no, that's true. And you're right. I mean, I think it was at 35% for a long time. And that 35%, to your point, Chad, it wasn't just that people weren't moving supply chains back here and infrastructure plans back over to the U.S. They were leaving the U.S., okay? Pfizer, Accenture, these are big companies, are no longer U.S.-based corporations. They left because they hated the taxes, all right? So the fact that we moved from 35 down to 21% was a total game changer for the competitiveness of our country. I cannot stress to you, and this is not a pro-Trump statement at all. What I'm saying is it was a game changer for our country for years to come, because you're right. We're seeing companies now moving supply chains from places like China back to the U.S. because it's cheaper to do business now. We have the most productive industrial workforce in the world, and and most educated for that matter too. So there are a lot of reasons to be bringing these jobs back. Now, the question is, now that it's at 21%, if they move it 28%, is it all going to fall apart? I think the odds of that happening are very, very low. Okay, because the nice thing about the Democrat plan is by them targeting 28%, tells the world that they even thought 35% was too high, right? Because if they didn't think 35% was too high, guess where the number would be right now? 35%. So the fact that the ceiling's at 28% is actually encouraging. Look, would I rather be at 21%? Absolutely. Look, but realistically, I don't think many people thought we were going to stay at 21% for all that long. We haven't seen 21% since the 1930s, okay? So this has been a great thing for the country, but if it doesn't end next year, it's going to end at some point in the future. At some point, this has got a big red bullseye on its back. I hope it doesn't change. In fact, if I were president, I would just lower it even further, frankly. I think the overall net effect of the economy would be infinitely better, but this is not going to cause a recession if it gets through. If they get a blue wave, okay, again, if Biden wins and the Democrats take the Senate, this is going to go through. I think there's a very high probability. Past that is where it gets a little bit murkier, okay? The third, they want to eliminate the step-up basis. Okay, so if I inherit a $1 million portfolio where the cost basis my parents had at $100,000, and that $1 million portfolio turns into $1.5 million, right now I only pay tax on that step-up basis from that $500,000. What they want to do is they want to eliminate this. So I would pay taxes on everything above $100,000. This is a really bad idea. I think this is very radical. I think this has almost no chance whatsoever of actually passing. This is a good example of politics versus policy. This is something that they could say on the campaign trail, but realistically, when it goes to implementation, this is going to be DOA. All right, first of all, it's almost impossible to determine what the basis is on a lot of these assets that are passed down over generations. Furthermore, you have a lot of Democrats, frankly, that are in a retirement situation where they don't have enough to retire on, and they are banking on retiring on using their inheritance. So you're going to go back to your constituents and say, oh, by the way, that nest egg you're going to retire off of, I'm going to take half of it, no matter what the size of it, $1 million or more, whatever it may be. I think this is a DOA item. I can't imagine any modern Democrat whatsoever voting for this thing. It would just blow my mind.
Reading through it, that was probably my biggest concern, because it was definitely one of the pieces that were attacking the less than $400,000 a year income earners, right? That was we're only going to hit the 400 plus, but the step up in basis. I mean, there's millions of people that receive inheritances. And that I thought that might have been one of the biggest hits in the plan itself.
It is, and I think this is just in there for kind of to raise a few eyebrows and get people excited. But again, even if Democrats were happy about taxing their constituents like this, implementing something like this is virtually impossible. You just can't. You couldn't measure. It's like the wealth tax that they're proposing out in California right now. it's impossible to measure because you based off your assets, and there's too many ways to manipulate it. They can't operationally run something like this, in my opinion. It's just too difficult. So I think this doesn't happen. If some variant of this were to happen, it would be something like lowering the threshold for the estate tax. Something like, you might see something like that, but not this. This is, to me, this is political suicide for any Democrat that votes for it. Which leads me into the fourth one too. I think this is also political suicide, and I'll explain why. Moving the capital gains and qualified dividends tax rate to ordinary income for incomes of over $1 million. You do this and you change the incentive for owning stocks. This is a very dangerous tax. I think the odds of this happening are close to zero. I'm talking like less than 1%. I think we have a better odds of an asteroid hitting the Earth than this to actually go through. For scale, okay? I had a long discussion with some very smart people at First Trust Advisors, and they explained something, a point that I never failed to think about that they brought to my attention was Jimmy Carter, the Carter administration, didn't even want to raise these taxes to a rate that they're proposing right now, okay? So not a single administration in, call it 30 or 40 years now, especially, and even Jimmy Carter, who was pretty liberal, they wouldn't even touch this tax. So for this to happen, like I said, this would change the incentive, the decision to own stocks. I mean, this is a bad idea. I think modern Democrats would balk at this. I think the odds of this happening are so low that it's almost off the table. They would have to get, the number of votes that they would have to get in the Senate for something like this would be mind-boggling. Now, the fifth one, this is where I think this is not going to happen, but this is a scary tax. This is a bad tax. This is a bad idea, just from a tax perspective. So the idea here for Social Security is the first $137,700 of your income, there's a 12.4% payroll tax associated with that. So if you make 250 grand a year, the first 137 gets taxed at 12.4%. Anything above that does not get taxed at all. Of that 12.4, 6.2% gets paid by us as individuals, and the employer pays the other 6.2%. Now, what Biden wants to do is for those earners above $400,000 a year to turn it back on. So if I, let's say, for example, make $500,000 a year, then my entire $500,000 gets taxed at 12.4%. This would be a really, really hard sell even for the Democrats, because you're going after people that are giving you the money to get reelected. And furthermore, they're showing estimates that this would only, frankly, push Social Security out another maybe 5 years or so, as long as 8 years. So this is not going to fix Social Security. This is not, in my opinion, this couldn't happen. And there's another huge hurdle here that the other of the big five here that don't have. This one, so if you go back to the budget reconciliation process, this is going to look geeky, Chad, I'm sorry, but I got to explain this. So if you go to the budget reconciliation process, as I mentioned earlier, tax code changes have been pushed through on a simple majority, but there's a caveat. There's an exception to this process called the Byrd Rule, B-Y-R-D, Byrd Rule. And that says, one of the stipulations in the Byrd Rule says, any changes to Social Security of any kind cannot go through the budget reconciliation process, meaning they are subjected to the 60 vote or more majority rule in Senate. That means that even if there's a blue wave, they will not have enough votes to pass this. They would have to have more than 60 votes in the Senate to get this thing through.
And like you said, there's still some moderate Democrats that won't accept it anyway, so they probably would need 70 seats or something like that to get it through.
Maybe even more. I mean, Chad, let me put it this way. You live in California and this tax goes through, your effective tax rate is like 65 point something, like 65 or 66%. Okay.
Wow. And then we see individuals actually leave the country when 2/3 of their income disappears.
At that point, you're right. You're going to see even more of a migration out of these high tax states, and they're already playing with fire. I can't imagine that happening in time. I mean, look, you're talking about the billionaires and the people in California. Here's a fun fact: is the top 1% of taxpayers pay it's something like 54% of the entire tax in the state of California. Okay, so you can't have that top 1% leave. You just can't. So they're playing a dangerous game there, and that's just not in California. I mean, you go to Illinois, you go to New York, New Jersey, Connecticut, all these places. This tax it's inconceivable how it would get processed through. Look, if I'm wrong, then look, you can yell at me later, but I just think the odds of that happening are as close to zero as possible. So to summarize of these five, the first two, if Biden wins and Congress gets the Senate, the first two are going to go through. And there's a couple small little ones that I didn't want to get. The tax plan's like 90 pages long. I didn't want to go through everything, but these are the two ones that I think are really going to matter the most. Awesome. So when I think of myself as so when I think of like, I know there are a lot of people out there that say, well, you know what? There's a lot of uncertainty. I'm going to sell, or even worse, we're going to see this. I'm telling you, this happens every election. The election day comes, or the day after, and my guy lost. I'm mad. I'm selling stocks as an emotional reaction to say that I think the world's going to end. Maybe I'm going to take out my promise and move to Canada, whatever it may be. All right. The problem with this, though, is that if you sell it on market because your Canada loses, you got to ask yourself three questions. Okay. Your plan has to be a little bit more than I'm just selling and going to cash, because if you go to cash, you're just losing money safely right now. One, will I stay out of the market until a new president is elected? Okay. By association, if I sold stocks because I don't like the person who won, then I would not want to own stocks until that person is out of the office. I think that could be 4 or 8 years. That's a long time to stay out of a bull market. Well, we're in the early stages of the bull market right now. Secondly, will you continue to sit on the sidelines if the market goes higher? This is the worst situation, okay? You sell stocks, more than likely to pay capital gains tax on that, and then you got to buy in at a higher price, all right? That doesn't feel good, all right? Any professional investor that's done that before, that is not a fun thing to talk about on the golf course. The third question is, if it falls and you're right, what's your signal to buy back in? When will you get back in if it actually crashes? Because getting out is one thing. Getting back in is a completely different thing. Your strategy has to be a little bit better than I'm selling because my guy lost. So I just think, going back to this idea of politics right now, don't let the emotions take over, because look, what is really driving stocks right now? Like, Chad, you're seeing it every day like I am. Stimulus. That's the only thing that matters right now. I took a screenshot here on the slide. I did a Google search. Do it at home. Stimulus effect on stocks. Enter. And in 6 different little Google ads here, you can see they're all about stocks going up or down within 24 hours, up and down, up and down, up and down, based on the hopes for stimulus. So if the stock market right now is fueled in the short term primarily by stimulus, and both candidates want stimulus, they're saying they want stimulus, okay? They want more of it, all right? If that's the case, then it's a question of when, not if. So if the market were to sell off or something crazy happens after the election, unless there's something that changes dramatically about the future direction of stimulus, this seems like a great opportunity to buy stocks that go on sale. I mean, I just want to show what Biden wants to do right now, because it's a big number. It's $7 trillion over 10 years. I mean, look at climate and infrastructure. I'm not quite sure what climate really represents. Nobody really does right now. But if it's a heavy infrastructure play, $2 trillion in infrastructure or close to that number, that makes me pretty happy. I mean, now obviously the government's going to be stupid about how they spend the money, but look,
aren't they always?
Even if there's some, there always are. But look, even if 60% of it gets through into good stuff into people's pockets through paychecks and improving the roads and whatever else they're going to do with this, hey, this is good news. Now, obviously, there are potential long-term ramifications about spending $7 trillion, the debt, things of that nature. But look, that stuff is, I know this sounds bad, but we can't worry about that right now. That's so far down the line. That could be 7 or 8 decades before any of this stuff causes a problem, way past the investable horizon. So we got to ask ourselves, what is this stimulus going to do? I'll tell you, stimulus is crack for the stock market. They can't get enough of it, all right? So if you're going to give the stock market $7 trillion of crack, they're going to take it every single dime, and they're going to get really excited about it along the way. So that's in the short term. In the long term, remember, look, I mean, Chad, I made this call back in June, and I know I got a lot of heat for it at the time. It was right around the time that the National Bureau of Economic Research called the recession had started back in February, and this is like in early June when they finally made the call. Yeah, they really on the pulse on that one. I wrote at that exact time that I thought the recession had ended in May. Now, I think we're in the early stages of a bull market. I said at the time, these are the 5 reasons why I think we are. And I went through them. And those 5 back in June are the exact 5 reasons why I don't think we should be selling stocks right now because of the election, no matter who wins. Because whoever wins, it's not going to change the fundamental drivers of the stock market right now. Look, the Fed's monetary policy, the Fed dropped interest rates to 0, and they basically told the world they don't want the stock market to go down. And they're the only entity on the planet, in the known universe rather, that has the power to control the stock market like that. Okay? They have told us they don't want stocks to go down for all intents and purposes. All right? They're keeping interest rates at 0. Their estimates are what, 2 to 3 years? That's garbage. I'm telling you, we're in 0 interest rates, in my opinion, for the next 7 to 9 years. It could be longer. I don't really know what the number is, but it is not 2 or 3 years, in my opinion. I think it's double that, maybe even triple. Okay? So in that instance, stocks look pretty attractive, okay? Especially when we think inflation's going up. I mean, look, we're already starting to see inflation in some of the numbers. Some of the supply chain disruptions from COVID, you can't get coffee in some areas, copper, iron ore, all these disruptions in commodities. And, oh, by the way, we also increased the money supply by 25% year over year. All right, so you can't, look, we're not going to have hyperinflation, obviously, but we're going to have some, I think we're going to have some inflation. And if we are, and the Fed has told us that they want to see inflation, okay, if it comes, one of the best things to own are stocks, because if I'm a company and my input costs are rising because the cost of copper is going up or whatever it is, then what do? I just raise my prices, okay? So I'm a hedge against inflation. So that's the reason why stocks tend to do really well in inflationary environments. So we have an economic recovery that's going on right now, which is kind of important. All right, we're seeing the economy recover. It's not quite as fast as we saw maybe a couple months ago, but it is recovering. All right, people are flying more. They're going out to restaurants, things of that nature. People are getting their jobs back. It's going to take a couple of years for unemployment to get back to where it was, but it's moving in a good direction. Entrepreneurship and innovation I talk about a lot. There's no way a new president is going to somehow cause all of the innovation that's going on in Silicon Valley to shut down. There's no way that they're going to fly out to Boston and say, hey, all you smart doctors curing cancer right now, I need to stop that, okay? We're going to make your lives so difficult that you're not going to be able to work on it. It's not going to work like that. Yeah, and think about where all the entrepreneurship and innovation in this country, in the world rather, is coming from. It's coming from here in the U.S. It's not coming from like Europe. I mean, what comes out of Europe except for wine and cheese these days? I mean, literally, all of it is here in the U.S. There's some in Asia, yes. There's some coming out of Israel and these small little pockets in the world, but most of it's here, all right? And that's not going to change. That's recession resistant in of itself. And the fifth, and this sounds like a cheap one or kind of a ridiculous one, but it's true. Where else are you going to go? Seriously, Chad, if you don't like stocks right now, are you going to go to the bond market? Bonds are yielding basically what cash is, almost what cash is yielding in some instances. Yeah. I would argue that the bond market is priced for perfection right now. It almost has to go down at some point. I don't know where else to go as an investor, right? So if you want returns, then to me, the stock market is really one of the very few places you could do and still maintain liquidity. So I look at the long term and I don't think anything changes. So like I said earlier, you asked me what my plan is around election day, is I want people to panic. I want people to get mad, not people on this call, obviously. I'm talking about other people. I want the investors to really lose their temper and say, I'm so mad that my guy lost, I'm going to sell all my stocks. Because the last time that happened was when Obama got reelected in 2012. The market, as you can see, dropped 6% for no reason other than Obama got reelected. And I love things like this because I try to be very, very gratuitous during times like these. You want to sell your stocks for 6% lower for no reason? Oh, okay. Yeah, no, I'm here to help. let me buy that off you. Oh, you want to sell those stocks? Oh yeah, no problem. Let me pick that up from you. No problem. That's what I'm here for. And that's what
here's the
professional investors
opportunity,
do
right?
so well.
This is what we're doing.
Yeah.
Yeah.
A month later, Chad, the market recovered after Obama. 1 month. And by the time he was out of office, 4 years later, the S&P 500 doubled. So look, if we see a repeat of this, yeah, okay, I'll buy more stocks. Sure. You know, whatever's in my asset allocation, I'll just take a little bit from other asset classes and dump it into stocks. I'll gladly do that. Nothing would make me happier. Because if this happens again, I'm not saying it's going to rebound in a month. I don't know when it's going to rebound. But if it happens because somebody wins, that's great. Because my point earlier, the fundamental drivers of what's pushing the stock market forward right now are not going to be derailed or damaged enough to warrant any kind of major changes. That's in the short term. Longer term, it's a little bit of a different story. That's going to take some time. I think that really, Chad, you and I talked a little bit about this. There are some things that you need to think about. I mean, again, if there is a Democratic tsunami of sorts, I think a low probability, but you need to start thinking a little bit more about your tax situation and how you can, kind of maybe shift things around, maybe some insurance options, whatever it may be to kind of optimize your tax strategy. And I think that, like I said, you and I were talking a little bit about, positioning in a portfolio. We don't know exactly what it's going to be because, again, like I said, we need to know what the policy decisions are going to be. But realistically, if he's able to push through what he's talking about right now, you're talking about in the stock market is shifting kind of the sector approaches and maybe some of the stock positions. But broad-based selling, I wouldn't see that being the case. It might be a situation where you say, okay, energy stocks, even though I'm not a huge fan of those already, but now's the time to maybe pull back a little bit more from energy and maybe shift that into some of the industrials or more of the infrastructure type plays, some of the healthcare opportunities that are out there given what they might try to pull off. Those are the types of things you can do on the margin that I think can help a portfolio. But what you don't want to do is you don't want to bet. You don't want to say, you know what, I think Biden's going to get this through Congress, so I'm going to bet today in November 2020 when it might be 2 years until that thing gets through Congress and another year and a half before it gets implemented. Because again, I'll stop with this. Obamacare. Obama was in the White House. The Democrats own Congress. How long did it take the Democrats to get that first health care plan in front of Americans? It was like 5.5 years.
Yeah, it was almost 6 years like later. Yeah. Yeah.
So, right, exactly. So almost 6 years later. So think about that. The next time you want to jump the gun or you sit there and you hear one of those pundits on TV or CNBC talking about how these are the 5 things you need to do on election day to prepare your portfolio, blah, blah, blah. There's nothing that is that time sensitive when it comes to policy because it moves at a snail's pace. So again, 3 conclusions. Election matters. It does. It absolutely matters, but so does a lot of other stuff. Okay. If it ends up being a headwind to the economy, remember the tailwinds right now, in my opinion, are stronger and they're going to last a lot longer. Vote with your ballot, not your life savings. The absolute worst thing you can do is get political about your investments. Okay. Push them to the side, check them at the door, and come from an objective angle. And third, focus on policy and try so hard to ignore the politics. I've never wanted a year to end more in my professional career. With that, I'll end there.
Awesome. Thank you, Michael. Some really good stuff. I guess one more thing that I know I'm getting a lot of as well is if they said, you know what, I don't trust either the president or the VP. And after a good long talk from you, I'm still worried about it. What is a safe place for that short-term money? Is it gold? Is it cash? Is it short-term bonds? What would be your thoughts if it's, I'm going to use this money in, 3 months or 6 months? Where would we look at that portion of it?
If you wanted to make a tactical move like that and kind of park the cash somewhere, even though I necessarily wouldn't say that's maybe the best move, but I understand that. And what and you're right, because Chad, what you don't want to do is get out of your comfort zone when it comes to risk. Okay, whether or not the opportunity is real or not is in my mind a distant second. You got to accept, you got to respect your tolerance for risk. So if that is the case, then what I would look for is there's a couple options. Yeah, you could look at maybe a mix of gold and cash to some degree. I would definitely stay liquid. There's a managed risk portfolio that we run that has a kind of a drawdown of a level of maybe 5 that is over time shown a negative correlation to down market. So if we do see some extreme volatility of any kind, that might be a way to kind of counterbalance that without necessarily sitting in cash and just losing money safely. There are options like that out there, but you do bring up a very good point. It doesn't matter how good the opportunity is. If you can't take that ride, or you can't, I don't want clients calling you, Chad, saying, I can't take this anymore, get me out at the worst possible time. It's not worth it.
Yeah. All right. Fantastic. Well, thanks, guys. If you have any questions along the way, you know how to reach us. We want to thank Mike for his time and his expertise. And if you have anything that comes up, give us a call. That's what we're here for. All right. Thanks again.